Everyone. Good evening, and hope you guys are ready for the Christmas. And today's webinar is about sharing a little bit of ourselves, of a company, and how we have been investing in the U.S. since 2018, multifamily-wise in 2012. And so we have been investing since when we were in the 20s. When we say we, is like myself and my wife, and we've been joining different group for long times. Back in 2013, 14, and we start joining different real estate group. And so let me share the screen just so you guys see what I see here. So it certainly is something that we along the way, by the way, so it's something that when we're learning how to do investment in the US, it was certainly not investing in the apartment buildings, not something that, we pick it up and let's go investing all this great, beautiful apartment buildings. So we didn't learn about how to doing it in US. So we start from small, like single families, and just like most people would pick something somewhere really hot, and we investing in Phoenix when we were really interested in the US is basically when during the last downturn. And so that was 2008. Everyone was really concerned about the downturn, and we get into the market in 2012. So something that is really I think is paid off many times is learn how to do investing in the market that that's not known as the number one biggest in terms of the economy, and is the most risk investing wise, except different kind of like capital from Canada. We investing from Canada, and we learn how to do it. But today we really want to share how people can really learn it and kind of take our system. If you want to do it yourself, hey, or if you want to see how we have been doing it, and something that we didn't create a system, we learned from someone, and just like you guys and girls, and trying to really learn the system, how other people have done it. So we had built just under 30 million asset USD, and 303 units in the US. Something that we continuously reflecting is this is a great goal, and it's a good place where it should be, where we'd like to be, and we would like to continue to grow. So that's one thing that we love about US is a really huge market that it have tons of opportunity, and it never in every market, everyone's that's come from Canada investing in US, and when they cross the border to the south, just like us when we learned how to do it in 2012, and later when we do it in apartments 2018, one thing that we learn is always more fearful than in here in the mind than it actually is. So today, I would like to share one investment opportunity, and that we are raising capital and working with investors, and we have raised over $1 million of dollars of fund, and we continue raising capital for that. Showing a little bit of track of what we have been doing it. Maybe someone that you are coming in, you're not interested in doing it passively. Hey, again, let me say that this is not something that we own the multifamily secret or formula. is something that has many investors like ourselves. There's 1,000 of companies that in the US that in our size, in this group, that has been, that's actually currently doing what we're doing. So this is nothing special. Maybe what's so special is we are we're working with Canadian investors, we're creating structures that is really easy for a Canadian investor to be working with us to invest in the US. Maybe that's something that's special. But in terms of what's so special, it's not something that we created formula. Once again, it is something that we create a fund structure, and we create, so that's a structure that can invest with Canadian investor with cash or other registered plans. On the US is something that is a lot of investors, a lot of people. They are investing with the retirement funds. So we certainly create the structures to make it easy for a Canadian investor to do it in the US, because we believe that is long time ago, we always we learned that you can use your retirement accounts in the US is 401k to invest in any kind of real estate in US, and it just make no sense that as Canadian investor they cannot invest with the retirement fund. Obviously, you have to make sure that you're doing the due diligence work, but it makes no sense that stuck with making so much fluctuations in the public market. Hey, it is an options. If a lot of people like to do the public investment, that's something that they can do. But we believe in that's alternative, and that's what investing in. We believe to working with private investors to be able to invest with the retirement registered account, whether there's RSP in Canada, I'm talking about TFSA and retirement income fund, and so on and so forth, and cash, of course, is very useful. So again, thanks so much for everyone's joining us today. And want to talk about a little bit of myself. So I have been investing in real estates for over 16 years, and I first started investing in Canada, in Calgary, buying condos that eventually live in and then rent it out. So we ventured out to the US, Phoenix, in 2012, and got our first out of the country investment. Over the years, we accumulate a little bit over 16 units at that time. That was 2014. So we invest in Canada, in Calgary, we're investing in Winnipeg, and we are investing in Phoenix at that time, and Hong Kong, and also China. So we trying to learn how to do it, but at that times, something that we really catch our when I say ours, me and my wife, really catch our eye thought is like, how can we grow that we can scale, how we can do it in a way that, you know, in Canada, we always heard about the financial wall of owning more than 5 properties is really hard. Given the real estate prices skyrocketed lately, it's probably even harder now. But long story short is, we learn about we first by doing it, like getting our hands dirty, you can say that, and going to US and eventually got our first apartment building in 2018, and we have grown. This year we buy 5 apartment properties, and we're closing another 2 before the end of the year. So something that we learned that is definitely scalable. With apartment buildings, you can pick up something that is, you know, 50, 60, 90, 100 units, and to be able to is really scalable. And that's a lot of them. That's another thing in the US. There's a lot of apartment buildings. There's a lot of different market. So it's long and short is it is a very healthy and it's also very capitalist environment as per what we learned in Canada. Because in Canada, it is, I love living in Canada. I'm in Canada, in Calgary. Calgary is my home, by the way. But one thing that I did learn is in the US, that's like different market, that you can go in and you can invest and you can learn about it and you can go there, and something that is very fascinating. So and we start to create our company. So since 2018, so we create something, that really focusing on multifamilies, and we really focusing on Ohio, right? And Ohio is on the East Coast, where most of the Canadians are residing, and the Toronto base is about 6-7 hours south from where the market that I'm investing in Dayton and Cincinnati. So something that I really focusing on is Class C buildings, and that we can go in and buy from the previous owner and to improve it. And that's why you always heard about, how can we do strong cash flow and value add opportunity. And this is what it's about, right? In the 1670s building that when we go in, that we can put our work, and we have a little bit of we call it the value creation of the wheel of circle that I'm going to show you, that that's really helping us. Again, we didn't create this formula. That is like thousands of companies, hundreds of companies in US and Canada doing exactly the same thing. But maybe what's so special about us is we create a structure so that we can work with Canadian investors to point the Canadian fund to either retirement funds or just RESP, TFSA, or just cash to be. We figure out structures, and so that the investor can invest in those structures and safely, and also get the great return that our friendly countries in the South they has been doing. So it's something that's I'm really passionate about, and I think this is something that should be more frequently out there. So we create structures, and to these days we owned 20 buildings and apartment buildings, just over 300 units, and 27 million USD asset, and just over 250,000 square footage of real estate. So those are the pictures of the buildings that we own. And so we create social structures that are able to give good returns, and to I would say to compensate the investors in a correct manner, because obviously everything that we do in the world, in the investing world, have risk associated with that. I'm going to be the first one telling you, whatever we do, that's risk associated with that. But one thing that we're realizing is, as we learn, as I said, like I have been investing 16 years, and I've been investing in US just 10 years now, just this year alone, 10 years. I went to US 2012. So something that we figured out that, by creating a proper structures, by consulting the right team, that in the cross-border way, that's one system in US and another system in the Canada. And it's really helpful because we have learned it the way when we get hands dirty and go to the market. And so something that I'm excited, and something that I'm really proud of, to be working with my partners, friends, to create a good track record. So excuse me. So we've talked about, the values, the value of creations. I was talking about how we create values. When we talk about great return, 25% return, for example, this is what we talk about, this investment. How can we create that? It's come down to what we call the value creation cycle. You can see that at the middle of that is what we're doing as a management team. And, it's one thing is we have to pick the right market. We believe in it very strongly. You have to pick in the right market, and we pick Ohio. We pick Ohio in a way that because Ohio have a really stable populations of just over 11 million populations. And a lot of actually big companies start to pay attention to Ohio. Intel is building their the chip plant that there's a direct relations result of Biden. President Biden is creating a chip act in the US. So they signed $75 billion of money that is supporting big company like Intel to attract them to moving there, because we all know that chip has been a big thing during the pandemic. So they're attracting those jobs and bring back to America. And where else is the best place to bring jobs to place that have like really affordable populations, affordable housing, affordable labor force, and it's about affordable land and properties. So there's no wonder as a lot of jobs is going back to the Midwest because of historically manufacturing sector has been a big stronghold in that area. So picking the market is a really important thing. And then now the second part is now you're going to identify properties, and then you infuse capital from day one. So no matter what we do, is the biggest part of what we do is we improve the asset. We improve the asset so that when we improve the asset, you increase the rent, because you can command higher rents. When you command higher rents, and after a year or two to stabilize the asset, by that means is that you make sure that the work is done complete, correct, by managing by us as in the middle. You manage a local team, manage a contract team, and then you get in the new tenants from this asset. You got to remember this asset. We don't pay top dollar for that, right? There's no value to that, right? The way that we're able to create value is by identifying the asset in the market that we work in, and we only work in those markets. We don't go to different places, and we only work in Ohio because that's our excellence, right? That's our team. So we target those markets with those assets and under market value, and then we infuse capital. And after that, we renovate, infuse the capital, doing what we do, what we call the lipstick renovations. We upgrade the kitchens, upgrade the hallway, make it nice, curved appeal. But again, we're not changing, we're not rebuilding, right? We're not developer going in, developing we renovated everything. We renovated purposefully, but usually when we come in, we can increase the rent. And usually the formula of when we're going in is we identify properties that within 30,000 to 50,000 of per doors. So something that's really attracting to us when we go into the US, because I come from Canada, I come from Calgary. There's no way that we can find 30 to 50,000 at the door that is charging the rent that we would like to be. So, and then after we do the work, we increase the rent. And then when we increase the rent, and that's where the top part of this circle is value creations. When you increase the income in apartments, actually in any kind of commercial, something that is really fascinating, and that's why I'm really exciting to doing apartments is when you increase the rent and you stabilize the properties, and that's what we call the operations excellence here, or stabilization. What we do is increase the value of the property. So again, finding the right market, finding the right property in that market, and doing work, stabilize it, increase the rent, and that's where the new value of the property is. So there's no secret. Once again, people has been doing it on different market. What is different from us is we focus on what we do well in Ohio. We have our team, and so this is our team. So we have local property management team, and we have insurance group. We have all these vendors. We have lawyers that creating our structures. And then we have, more importantly, we have obviously we have investor coming with us along with our lender in the US. So with that, we create something that look like this, right? So this is our first building. So we got this building. This is called Amy Apartment. We changed the name to Springbank Apartment, as you can see. We got it just under 28,000 a door, a unit at 1.3 million, 1.32. That's 2018. So within 24 months, so we increased the occupancy, increased the rent from 350 when we take over the building to 625. And what we do, again, we purposefully increase and improve the unit, and new management, new branding, but more importantly, we didn't spend a lot of money, right? As you can see, we spend enough money so that we can go in and really bring up the hallway. I still remember we spent under 3,000 per hallway, new floorings, tile floorings, new paint, a little bit of decorations. But in the unit, when the kitchen is salvageable and we don't have to do the cabinet because it's expensive, so we repaint the cabinet, for example. We put a new floor usually, and then in the bathroom we put a vanity, and on the kitchen we have a new floor and new countertops, because that's actually good values. People like to touch, tenants like to touch what new things when they're going in. So again, we don't change everything new, but we change purposefully what we have to, and the result is increasing the value of 1.3 million to 4 million. So that is a really good example. Remember, at that times, that was 2018. So we go in and we partner with someone that we hire, actually a local management team, and so that have like decade of experience, 35-year experience. To this day, we're still working with the same company. And what they help us is to give us something that at that time we didn't have the local experience in terms of how we running the asset. A business is actually a business in local Ohio. So we partner someone who has been doing this for decades, 20, 30 years. And we partner someone who have experience to doing the renovations. We partner with someone who know how to manage Class C buildings. And maybe most importantly is active management. So we don't just say, this is a project, go do it, right? I go there every month, and I still go there every month to make sure whatever we set to be doing, give it to the local management company to execute. But at the end of the day, is very important for me to be able to have a close tab on the local property management company, because at the end of the day, is our capital, is our investment capital. We have fiduciary responsibility to the people who partner with us. But long and short is we really fortunate, and we're really happy that it turned out to be a good property, and we still own to this days. So we put in new roof, we put in some of that new HVAC, mostly AC units, and some of that water heaters. But long and short is it's a growth project that we're able to improve their values. After these projects, something we find out is actually this is very interesting, because now remember, before this is everything just on the books. But one thing that we learned that this is a repeatable business. So what we do, we go do it again. So this is the second apartment building. It's called Claypool Apartments, and we changed the name again. It's called Woodbank Apartment now. So the idea is simple. Once again, I shouldn't say simple, it's the same. So we go in and acquire something that is need work, need love and care, and we infuse capital into it. And in this case, we infuse $500,000 of capitals to do basically the same thing. We hire the same team. So one thing that I do want to stress is we didn't recreate the wheel once again. Now we have so-called the recipe of creating the same results. After we did the first project, we did the same thing, except it's faster. The last project, we did it in 24 months. This one, we complete the work and come back and to increase the occupancy and to increase the rent from $470 to $800. So remember, property like this, they are usually have like in the 60s and the 70s. They built a long time ago, and the previous owners, and many of the case, they're tire owner. So they have owned it for many years, and they didn't want to do the work that we're doing it. Infusing the capital is one thing, because you can get it from the bank, right? But managing it well and managing well their cash flow and provide a decent return to investors. And that is another thing, right? Because across US and even in Canada, that's many, that's like thousands of projects like this. At the end of the day, it's come down to, remember the circle that we talked about, is coming down to the management team. Because you got to remember, the local property management or the contractor, they are not going to have the same stake as in you and I when we're going in. This is our investment. And to them, to be honest, whether we're able to raise the rent, whether we're going to do the work as we want to be, at the end of the day, they still get paid. We only get paid. I'm talking about management. They only get paid when we're doing the right job at what we deliver to the investors. So it's very, very, very important. So, but I'm gonna share with you, it get better because number one thing is now we have the recipe. We know what we have done, and we're just recreating the result once again by basically, you can call it there's a mold of result of success that we learn it from the first project. Now we duplicate it on the second one. So the simple result is now we buy it from this building, 48,000 a door, and it has like 22 2-bedrooms. So that's why you see that the price is higher, but at the 3.38 price tag. And when we refinance it, that property value go up to 6 million. So it's nothing new. I'm going to say that this is not new. There's no different from what we have been done. But what is different is one thing that we learned, that actually now we know that we can recreate the same value, right? We can redo the same thing over, because we have done it this second time we did it. And we bring in more investors who work with us, because now we know that, the first time it works, and the second time works. So now we kind of like, this happy child, like kind of bouncing on the floor. You know what? Let's do more, right? And this is our third property. And so this is a different market in Cincinnati, but it's still in Ohio, as I said. So we bought it at 40,000 a door, and it was instant equity, because if the property were appraised at 1.2 million at that time. 40,000 a door, 26 unit. Again, we didn't do anything different. The same market, same type of property, C-class building, great area. And so we look at how competitions, how much they're charging, and that's how we determine what we can charge when we stabilize the building. Okay. And when we looking at our competitions, not only looking at the rent, we're also looking at how they improving it. So that's very, very important. When I, at the beginning, go into a market to say, you know what, I maybe want to buy this building or this opportunities, before I bring my investor along. One thing that I do homework is I walk the 3 miles, 5 miles radius of my competitions, similar type C-class building, 60s, 80s. I see what they did. See what they did. What I mean by that is what kind of work they have done. Did they change the curtain? Did they change the drips? Did they change the window? Did they give new amenities to their tenants? So this is no secret, by the way. This is the same thing when I do the first building. I also go in my competitions within my 3 to 5 mile driving distance, because to be honest, you got to remember, my tenants, when I stabilize, when the building stabilize, they come into the building, they look at my finished product. They also looking at my competitions. So this is not so much different from when you're building anything. You're looking at the competition, what they have been doing, and how much they've been charging. So it give me basically is the due diligence homework. When we going into every kind of opportunities, I always look at my competitions. Competitions meaning the apartment building, like on the same street over there, 3 miles, or on this directions, 2 blocks away. So again, I look at how much they're charging, what they have done, and when I look at this building, I still remember I was looking at one competition. Basically, it's a stone flow. They're better apartment complex, more established. But one thing that I found out is I was charging 300, like the sellers of this building is charging 375, right? As you can see, my competitions is charging over $1,000. Now, don't get me wrong, they're better finish, better managed, complex. But hey, we talk about 375 versus like over $1,000, 1,050, I still remember, plus utility. So that's how I set up my floor, right? When I say, you know what, I know my building can charge $700 a unit. And that's how I basically achieve that. Actually, it's charged increased to $775 as I increase it, because it takes when I close the building, the market is like going up market. So of course, when we doing that kind of work, then we know our so it's very important when we're buying physical asset like this. You know, you can basically kind of predict what is the building will be doing when down the road. Because really important. The bank is going to ask me, right? The first thing, the bank and the lender is in the US, and it's going to ask me, so how do you know what is the value? How do you know that 2.35 is going to be, right? Well, it's come down to how much rent I can charge when I finish the renovations. They do the rent comps, right? I do the rent comps too. I do the rent comps of myself, right? As I told you, when I walked in my competitions. But at the same time, I also do get online reports from my brokers, from CoStar, from NewNet, so I know what they're charging in the bigger areas. So so doing those kind of work make it more manageable. As I said, first thing that I've been sharing on this webinar, anything that we do in life have risk. When we're doing bigger project in the US, renovation project, value projects, that's obviously have risk. We talk about 25% return per year, right, for 5-year hold. So everything has risk. But doing this kind of work, doing this kind of understanding the market and understanding what we can charge, and that is the reason why we're able to work with investors by doing repeatable results. Because you got to be able to defend and support the rents that you're going in, because in 6 months or 3 months when you go into the renovations, it's going to be very obvious you can charge the rent at that level or not. So so this is our third properties, right? And we changed the name from university apartments and to college bank apartment because it's actually close to university. So it's a walking distance to a local college. So one thing that we realizing it is very important to find the property in a decent area, right? And it's important to find it. It's important to find property in a good price, just like this one, 40,000 unit. But it's also very important to buy property in a good area that you can rent out, and whatever that you're doing in the renovations, you know, it's going to be worth the money, because you don't want to put expensive renovations into a building that can be improvable. Any building can be improved, but in a not so good area. So so again, we stick to the same formula by identify those property and improve the capital, infuse the capital, and improve the inside and the outside curve appeal of the building. So once again, this is the third property, and then move on to the fourth property. And once again, we got this building. This is 72 unit in the Dayton market. We got it earlier this year, and the properties is not in a bad shape, actually, this one. But what they were not doing is they didn't increase the rent as per what it could be, the market range could be. So when we're going in is for $490 per month. We'll talk about average 1 bedrooms. Most of the units on this 72 unit is 1 bedroom. And then we already doing renovations. This is early this year. And we had tested the market, and we know the market can bear over 700. Actually, we rent out last month 1 bedroom unit at 725. Once again, the theme is really recurring, is doing the same thing over and over again. In investment, I believe is good, because it's test. It's something that we able to say, hey, Mrs. Investor and Mr. Investor, this is something that we have done, and we have done it over the years. This is not the first property that was the first project. I do not like to use your hard-earned money to use experiment. So this is the fourth project, so once again we get the capital, renovation capital from the local lender, local bank, and then we do the renovations that we determine what is our competitions. This is the kitchen they're giving them, and this is the floor they're giving them, and this is the amenities they're giving them. So we replicate so that we are competing with our local competitions, right? Within the 3 to 5 mile radius. Remember, I'm mentioning it. And then, so we don't over renovate. So this is one thing that because it's very important. Remember, when we're doing single families, back in the days, when you over renovate it, it's only 1 unit or 2, right? When you have a basement. So now we talk about this building alone. It's a 3 buildings. Each one of them had 24 units. So 72 units. And think about this, if you're going to be over renovated 72 units, even if it's like a couple thousand a unit, so you're talking about tens of hundreds of thousands of dollars. So it's very important that when you're going in, what is your cost, right? By means that, one thing that I didn't mention is how we know that how much money we're going in. So we learned it from the first project, second project, third project, fourth project. So how can we estimate the price that is relevant to the local Ohio market, right? So over the course, price increase, so is the property value increase, so is the rent increase. But it's very important to know where we're coming in. The last 18 months has been a very interesting environment. The rent has been increasing, but so is the building cost and the construction cost being increased, right? Because of supply chain and so on and so forth. So, so to be able to, again, execute that and control the cost to be, you don't want to control the cost in a way that no one's worked with you, right? But you don't want to overspend in a way that you're going to have a nightmare during whenever it's completed. Because at the end of the day, controlling the capital expense, that's what we talk about, 640,000 is very important. So, so this is called tri-court apartments. So we have keep the same names over the years, over the months. But so when we completed, so that we returned this building from 3 millions to 5 millions. So just because of what we know by going through the first 1, 2, 3 projects, and this is what we're able to do by, again, find a property that is not over expensive, under the market values, but more importantly, under the market rents, because you know that your competitions, what is the rents. And then we also closed this in the summer. This is 48 units along with the last one. The idea is, once again, is we picked this up at $2 million and $2,064,000, same price, 43. So this building and the last one is kind of like sister building. What we able to do is to increase the rent by doing the same thing, improve the curve appeal, improve the inside the units, by improving the values from that $2 million buildings to a little bit higher than 3.4 millions. So once again, this is not something that we want to recreate the wheel. We want to keep repeating what we have been able to do with by using the same management team, the same contract, the same touch and feelings. But most importantly, we don't have to relearn the market because we already know that. And so this is the 40 units. So we move on. So we close. So this is just going to allow me. I'm going to scroll up. Sorry about that. We're going to make it easy. So this is first building, second building, Claypool, and the third and the fourth tri-court, and then the fifth, and then not last month, October, we close on the sixth building. So when my apartments are 40 units, we able to get into the market with 30,000 a door. So so when we work in the same market, one thing that we realize is you're able to get to some of the properties that in a more decent price. And obviously what that means is you're able to increase the value, but even not that much to create the values that you can share with investors. But once again, the idea of doing this kind of value add is actually very similar. Find properties, the values creation that we're talking about, find properties that is undervalued, that have potential to increase the rent, and increase it from 450 to 750. So this is project we closed in October, and we're obviously in the middle of renovating and upgrading it. Something we learned that this is not hard work, but this is smart work. But this is something that it is hard at the beginning, and then you just keep repeating the cycle, repeating the building. So it's not something that we want to recreate the strategies. So with the experience that we got, that we have been doing properties, we have been buying properties in Dayton, Ohio. So for something that we say, we think that was really interesting and it's really compelling to offer investors. We actually closing a 90-unit building, and the property is actually within Dayton, as you said. It's called Million Apartments, and is offering 25% investment returns, and with 7% cash flow. 7 is a part of the 25, and so the target is 5 years. So once again, we're not creating something new. We go to the same market and look for similar properties, and we just do it once again. And it's 90-unit building. We believe it's strong value add. So the building itself, as 8 buildings, had the really spacious of 900 square feet per unit. A lot of them is 2 bedrooms. About 62 of them is 2 bedrooms. So that's why it make it more larger size. And I think everyone is talking about recessions. So I don't know whether we're heading in recessions. No one knows about it. But one thing I do know that when you have a bigger property in terms of bedrooms, if the recession hits, it's actually more safe, because a lot of families, they would condense, family and friends would condense it from, if they have 2 families, sister and brother, they're renting 1 bedrooms each, let's just say that. What they will do, they will combine it into 2 bedrooms and increase the occupancy of buildings such like this. So we bought it. We are going to contract on this building. We are closing, in the middle of closing it at $44,000 a unit, and we figured out we can increase the rental increase from $250, including utility charge from where they are. One thing that we really like, this is close by the University of Dayton, have close to a CDB, Central Dayton Business Unit, and have strong family settings that able to have tenants, so-called in the areas. And one thing that I have shared is like big company such as Honda and Intel. So Honda is building, and LG, Honda and LG is building. Historically, Honda has a really strong presence in the area. But one thing that they are doing is they are building our $4 billion plan with LG, Honda and LG. They're creating basically EV plan for the Honda EV vehicle. So Honda is doing it. Intel, as I said, they're building facilities, 2 facilities, building a chip, and that is on the east side of Dayton. So all these jobs is what it does is basically create a very healthy environments for the people to going in to be basically living in, I would call it affordable environment in the US. Because in the US, as just like in Canada, the market has go up so much. So, but the thing is, as the real estate price go up so much, people still need a place to live, where they are not able to buy properties, they need to rent. So something that we know that for the next, the generation set and the multi-millennial generation is basically, they are a cycle. They are a demographics that they're going to rent. A lot of them is going to rent for a very, very long time. So when we talk about $600, $700, $800 of rent, you cannot compete with when the average mortgage payment is $1,700. So long and short is the difference between owning and paying the mortgage from the difference of paying the rent. the difference is so high that it's giving advantage like investment like this, like partner like me and our management group to go in and buy this building and offer to the tenants. So that's something that at the biggest level is happening. But long or short, at the end of the day, it needs to be a good bonus, right? So look at this building, 90 unit, once again, 8 buildings, 1, 2, 3 stories. That's multiple building. That's why it's 1, 2, 3 story. And building in the 60s. Pitch roof that I really like it because at the end of the day, when you get a pitch roof, you get less insurance premium compared to the flat roof. And so you have, again, there's nothing. This is, remember, this is Class C buildings, Class C properties that you don't go in and do whole renovation change and make it a Class B and Class A. So that's very, very important when we go into and work with our property management company. And when we give them, this is the way that you're going to renovate the properties. And this is how you're going to qualify tenants. And you don't over qualify, you don't over renovate the buildings. So something that we have experienced on all the 6, 7 buildings, properties over the years. And again, once again, is what is really important is our ability to predict our results. So our ability to do just the right thing by putting the right investment dollar and manage it at the way that we have been managing in the previous investment. So so this is a really simple example of like when someone investing 50,000 in investing in a project, and this is what they get. They would get 7% during the first 1, 2, 3, 4 each individual year, 7% cash flow distributed quarterly. At the end of it, the 25%. If you look at this one, it's better. So 25% minus 7% during the cash flow, free cash flow years is 18. And then the ballpark of that is 18. 25 minus 7 is 18. So 18 times 5 is 90. 90% of the return we call it capital growth is released at the year 5. The year 5 at the end of the year 5, where this is an investment that requires 5-year hold. It's a 5-year commitment. But once again, something that we have been doing this since 2018, and we have never missed an investment payment to investors, something that we really, really truly very, very proud of, and really to the heart, you can call it. Because at the end of the day, our reputation stops when we stop one payment, if you ever did it. So we never skip any payment. One thing is, when we're going in, we know how much we're charging. We know how much we're promising the investor, and we know how we can balance the book. So it's something that we have done at first, all the way to the 6th project, that we have some experience to work with investors, some investment working in the market, some experience working with a type of investment that we know that it can perform that way. So by investing 50,000, the total return is 62,500, and then return of your own capital. So once again, by putting 50,000 in this, for this example, by this projection, 25% return, is going to get $112,000, $500 as a return, including your capital. And then it's just more of the same. 100,000, the numbers, the percentage is the same, but now it just give you an example of when someone investing in 100,000. So I hate, to be honest, I hate to do this diagram, because actually we are revamping our website. Investor can actually put in exactly how much they invest in something that I'm really excited by putting. It's kind of like calculator. Actually, it's nothing fancy. And before I invest and I started my company. I am an engineer by trade, so I'm really excited when someone can drag along the space, the graph of the bar, and able to adjust the return. Right, when you adjust the income, I mean the investment original principle, and that's just how you get. So something that I'm really excited. I'm working with my teams that able to provide that. But long or short, this is the same percentage return from the $50,000 investment. And we accept both US and Canadian. And so this is just showing USD. And then this is the same 7%, 25%, when someone invests in 100,000, when a partner invests 100,000, the total return is $125,000. Therefore is 125% return, right? 1.25 and return of your original capital. So at the end of 5 years, when someone invests, putting 100,000, including the 100,000 return at the end of 5 years, the investor will get back $225,000, including the return on capital. But once again, this is the same principle. This is the same numbers as the 50,000, and this is just a repeat of what we say in the words 125% returns and 5 years commitment. As I said, the really important thing for us as a company is at the beginning, we wasn't able to offer registered plan for investors, something that we really excited, and it has been up and running since March this year. So we worked with Olympia Trust as our administrator to be able to invest along with an investor with their RSP plan, TFSA, RRIF, RESP, LIRA, all those kind of self-directed account. It's something that is really easy for investors, that they can go into their own portal, right? Their own Olympia Trust website, and they can find and search and just make it more legitimacy. So it's really something that we got exposure by working with someone that has been in the register area for a long time. So you can, as this screen show, you can search our company firm, Hey to Break Real Estate Trust, and then you can invest by just depositing the money into your self-directed account in Olympia Trust. So, and this is something that the pictures that I take during the summer and the winters, I've been going back and take some more pictures. So as you said, this is decent buildings and decent parking lot and decent roofs. And I think this is page 25 to 26. I think that is it. So I'm going to say that is the end of this webinar. And I would like to say thank you so much for joining us today. And once again, we're really happy to be showing this. This is actually a third webinar. I've done 2 similar webinars before this one, and something that we're really proud to work with investors along the way. So let me know if you have a question. You can raise your hand or just ask a question or contact us. This is our website, and this is my email. Feel free to drop me a line or just reach out for a call. But at the end of the day, thank you so much for taking the time to join us today. And if you have questions about this or investing in passive investment in the US, investing in the apartment space, so this is my email, and this is the deal. And thank you so much for joining us.